You think you're trading the euro, but you're actually trading the dollar. You think you're long oil, but you're really just short the US currency in disguise. And if you don't understand correlation, the market is going to punish you for it every single time. Let me ask you something. Have you ever put on what you thought was a diversified portfolio only to watch every single position bleed red at the same time? That's not bad luck. That's correlation doing exactly what it does. And most traders have no idea it's even happening. Here's the truth. Nothing in the market moves in isolation. Everything is connected. The dollar rips higher, and suddenly your long euro position, your long yen position, even your long gold position all tank together. You thought you had 3 trades. You had 1 trade repeated 3 times. That's not risk management. That's concentrated exposure dressed up as diversification. Let's break this down. The dollar index, the DXY, is the godfather of forex. It measures the dollar against a basket of 6 major currencies: euro, yen, pound, Canadian dollar, Swedish krona, Swiss franc. When the DXY moves, it's not just one chart going up or down. It's a gravitational pull across the entire forex universe. You need to understand this. When the dollar strengthens, almost every other currency weakens. When the dollar falls, risk assets rally and currencies start dancing. If you're trading any pair with the dollar in it, you're trading DXY whether you realize it or not. Now let's talk commodities. Oil and the Canadian dollar. This is one of the tightest correlations in the entire market. Canada is a major oil exporter. When crude rips higher, the Canadian economy benefits. The loonie strengthens. When oil crashes, the Canadian dollar follows it down like a shadow. You cannot trade the Canadian dollar intelligently without watching crude. You cannot trade crude without understanding what it means for currency flows. They are 2 sides of the same coin. Then there's gold. Everyone loves gold. Safe haven, store of value, hedge against chaos. All true. But gold doesn't move in a vacuum either. It has an inverse relationship with real yields. When real interest rates rise, gold gets crushed. Why? Because gold pays no yield. It just sits there. When bonds are paying you real positive returns after inflation, why would you hold a shiny rock that does nothing? You wouldn't. When real yields fall or go negative, gold becomes attractive again. Suddenly everyone wants that shiny rock because bonds are paying nothing or less than nothing after inflation. You see the connection? Here's what most traders miss. They stack positions that feel different but are actually the same bet. They go long euro, short dollar index, long gold, and think they're spreading risk. But if the dollar rips because the Fed stays hawkish and real yields spike, all 3 of those bets lose at once. You just tripled your risk without knowing it. Correlation is invisible until it's not. It hides in the background during calm times. Then volatility hits and suddenly you realize your whole book is one giant directional bet. That's when accounts blow up. That's when traders who thought they were being smart get humbled fast. So, what do you do with this? You start watching the big picture. You stop trading pairs in isolation. You ask yourself, what is the dollar doing? What are yields doing? What's happening in commodities? You think in terms of themes and macro flows, not just individual charts. You understand that trading is a system of relationships, not a collection of random setups. This is just the surface. Understanding correlation is one thing. Knowing exactly how to use it, how to measure it, how to build a portfolio that actually manages risk instead of concentrating it, that's a whole other level. And that's exactly what we're building for serious traders who want the full framework. If this made you think differently about your trades, hit subscribe. The game is changing. And the traders who understand the connections are the ones who survive what's coming.